Okay, so the last chapter is on the transfer pricing. So before talking about transfer pricing, we need to be in terms with several concepts. First of all, we're going to talk about the intersegment transactions. So intersegment transaction is nothing more than transferring products and services between the segments within the organization. So if there is a segment that is selling a tire, then there will be a buying segment that is purchasing a tire from the selling segment. We usually call it as a segment. It can be a subunit or even a division. But whatever that is, um, we can just throughout use the term intersegment transaction. When you are setting up a transaction, just as we have a price in the market where we use that price to transact products and services, there is a transfer price, which is a price that is established when transacting the services or products from one subunit to another subunit. Okay. And we also are going to assume that the organizations are usually decentralized, meaning each subunit has decision right in terms of whether or not to buy or sell certain products or services to another subunit. So transfer prices are used to coordinate the actions among these independent subunits. The products that we sell to another subunit or buy from another selling unit is called the intermediate product. So that is the product or service transferred between these subunits of organizations. Okay, so you should be familiar with the term intersegment transaction, transfer price, and the intermediate product. There are several factors to consider when establishing a transfer price. First, we want to make sure that we set a transfer price that is goal congruent, meaning it should not harm the segments, but also it should not harm the performance of the organization as a whole. Okay, so we should make the goal of the subunits and the goal of the organization as a whole to be aligned. That is what's meant by the goal congruence. And then there is the performance measurement. So whenever we set a transfer price, we need to also understand that transfer prices can affect the bottom line number of each subunits because transfer prices are revenues to the selling subunits. It is also a cost to the buying subunit. So both of which can directly affect each subunit's profits. Okay, so transfer prices are used when we are measuring the subunit performance, and therefore it's crucial for each subunit to decide how much price they're gonna set. In order for transfer price to be goal congruent, and also it should be aligned with the profits of each subunits, each division should have an autonomy. Each division should have an independent decision making to decide on whether or not to uh, purchase or sell the intermediate goods. Sometimes, if there are too many divisional autonomy, though, there can be a goal incongruence, meaning each subunit may gain profits out of these transactions, but as an organization as a whole, it may actually lead to a company's overall loss or at least decline in profits. So goal incongruence is also named as sub-optimization. It's not optimizing the decision. It's not optimizing the profits of the overall organization. So it's called a sub optimization. Transfer prices are also used for internal taxation purpose. There are many multinational corporations nowadays, right? And one of the key consideration for these multinational corp is that taxes differ across different companies in different countries, right? So there is a one key strategy many US state companies execute, which is to apply the transfer price for international taxation purpose. Let's say there is a US firm that has different facilities within the US. And in the end of the year, they gain a profit of $1 million. Let's say that the tax rate for the firm is 35%. Therefore, it leads to $350,000 in tax, leading to $650K in profits. And the executive of this company thinks that the tax expense is too high when they gain profits all in the States. So they decide to engage in the intersegment transaction. The way they do is they set up a company in an island like the Bermuda. Let's say this island faces only 5% tax rate. So the corporations that are incorporated in this island um, may only have to pay 5% out of their profits. So this company sets the another subunit in Bermuda where this division has all the intellectual property like the patents of the company, the trademarks of the company. For example, if you want to use the word McDonald's, then you have to pay the trademark to this division that owns all the intellectual property of the parent company. And then like the copyrights. Okay, so whenever the company uses certain patents or trademarks, then they have to pay those to this subunits that is established in the Bermuda Islands. Okay, so once they use their intellectual property, they're gonna pay such licensing fees to the subunits. Let's say that after this transaction, so after the licensing, now the parent company has to transfer $800,000 out of the $1 million to this Bermuda island subunit, right? Leaving only 200K in the States pre-tax. After the tax rate is exposed, now they have to pay $70,000 in tax to the US government, leaving $130,000 in the profit. How about in Bermuda Island? Now the tax rate is 5%, leaving $40,000 to be paid taxed and $60,000 to be profit. Before licensing, the company only earned $650,000 after tax. Now they're gaining 130K plus 760K, which is about 890K in profit, right? This means that if you use the intersegment transactions wisely, you can actually gain a much hefty after-tax profits, right? So actually the transfer prices are mainly used for international taxation purposes, for especially the multinational companies. But our focus is not going to be on taxation. It's more about what type of transfer prices there are, meaning how do we set transfer prices? There are mainly three different ways. First, market-based transfer price. This is the transfer price observable from the external market. Either you get those information from trade association website, or you can get it from external market, external exchange places. As you see on the figure right hand side, this is a commodity price website. So National Agricultural Statistics Service shows the price of apple every day. And from this figure, you can get the price of apple in an external market. So as long as you can see the price from the external market, you can easily refer to that price and apply that price in the intersegment transaction. Second is the cost-based transfer prices. There are two ways to set cost-based transfer price. First is variable, meaning you only set the price based on a variable cost that's been incurred rather than based on variable plus fixed. Of course, some subunits may charge transfer price based on the full cost, which is variable plus fixed. And today we are going to see both cases. When I mean by cost, it can be based on the actual incurred cost, but it can also be based on the budgeted cost that is predetermined at the beginning of the year. Lastly, many subunits actually use what's called a hybrid transfer price. It's a hybrid of both market and cost-based transfer prices. So usually there is a range where the seller and the buyer can negotiate on which transfer price they're going to use. It's often an average between the market and the cost-based transfer prices, but not necessarily so. And in practical sense, it's usually based on a negotiation between the selling subunit and the purchasing subunit. In order to look at each cases of market, cost-based, and hybrid prices, we're going to use a example of a hypothetical company called Horizon Petroleum. Horizon Petroleum is a refinery where they have two divisions. The one is transportation division and the other is refining division. Basically, the transportation division gets a crude oil from external supplier of crude oil in Matamoros, Mexico, which is south from Houston, Texas, as you can see from the map below. Basically, transportation division would purchase such crude oil in Matamoros, Mexico, and transport that from Matamoros to Houston, Texas, using the pipeline, as you can see from the right-hand side. And then in Houston, refining division would process those crude oil into the final product, the gasoline. Okay, so remember that crude oil is different from gasoline. Crude oil is the raw oil before being processed, whereas gasoline is the processed oil, the final product that's gonna be sold to the final customer. Okay, so we're gonna look at several illustrations. First, let's look at the transportation division side. Transportation division has a long-term contract. Let's say it's like for 3 to 5 year contract where they purchase the crude oil from Matamoros fields at $72 per barrel. And then the pipeline from Matamoros to Houston can transport 40,000 barrels of crude oil per day, which means the capacity of the transportation division at a daily level is 40,000 barrels of crude oil. For the transportation division, they incur costs when they transport such crude oil to Houston. Variable cost per barrel of $1 and fixed cost per barrel of $3. Okay. Now let's move on to refining division. Refining division is a division that processes the crude oil to the gasoline, and it has an operating capacity of 30,000 barrels per day. Now, 10,000 barrels out of 30,000 barrels are going to be supplied by the transportation division, so from Matamoros to Houston. And then the other rest, 20,000 barrels out of 30,000 barrels, are going to be purchased from another producer from Houston at $85 per barrel. After then, the refining division goes through processing into the final product gasoline and then sells those final product gasoline at $190 per barrel of gasoline. Okay. Note that it takes 2 crude oil to generate a barrel of gasoline. All right. For the refining division, the variable cost incurred is $8 per barrel, and fixed cost per barrel is $6. Okay. Okay. Now, there's one more thing to be cautious about. So when I say a word per barrel, it's not always per barrel of crude oil. So from the transportation division side, it's gonna be per barrel of crude oil, whereas for the refining division, this means per barrel of gasoline. That's the difference. All right. This is a visualization of what I have just illustrated before. So it starts off from transportation with a max capacity of 40,000 barrels. And then it buys a crude oil at $72 per barrel under the long-term contract. And then sends off the 10,000 barrels to the refining division. Refining division has a max capacity of 30,000 barrels. So they have 20,000 barrels more from the supplier at Houston. So they buy crude oil at $85 per barrel. And then lastly, they sell those gasoline at $190 per barrel of gasoline to the outside consumer. Okay, so keep this in mind. And we're gonna see each of the prices more in detail. So when are market price used? Basically, market price is used when market is competitive. Competitive market means that there are so many buyers and so many sellers in the market. So whenever you want to sell, there is always going to be a consumer. Whenever you're going to buy, there's always going to be a seller. And then we're also assuming the product is homogeneous, meaning the product is not differentiable. You cannot differentiate the gasoline from this company versus the gasoline from the other company. They all look the same. Okay, so from the buyer perspective, there is no difference in buying the product from your company versus from your competitor's company. And then another feature of competitive market is that firms are price takers, meaning they cannot set up the price themselves. Price is already there from the external market. Okay, so the price is always going to be the same, whatever the quantity is going to be. And the another thing is that in the competitive market, we're also going to assume that each subunits are gonna be very independent. They're gonna be having no, almost low interdependencies across each other. So there is no negotiation going on between these subunits. All they care about is the price that is observable from the external market. Also, when you are setting the market price to be the transfer price, there's definitely going to be no incremental cost or benefit compared to buying or selling from the external market, right? So you can make any differences on buying or selling internally versus externally. It's always going to be the same market price. However, in the next slide, we're going to see a case where the market is not perfectly competitive, meaning the market, there are not many buyers or sellers, and products are not necessarily the same across different vendors. And more importantly, firms are not price takers. Okay, so firms can set their own prices themselves. Okay, so out of these three features, to be the imperfect competitive market, the feature that is most important for us in our context is that firms can establish the price themselves. So in that case, we will see a case where the transfer price is actually going to be set below the external price. Okay, but it's always have to be the case that the price is always going to be above the selling division's variable cost. Otherwise, there is no reason for the selling division to sell at a price that is even lower than their variable cost, right? Then they're always going to be facing a loss, right? So always make sure the transfer price is below external market price but above the divisional variable cost in an imperfect competitive market. So in a Horizon Petroleum setting, back to where we were, if they are applying the market-based price, then it's gonna be the external market price of $85 per barrel, right? If you see the visualization again, they already buy at $85 per barrel of crude oil from the supplier at Houston. So $85 is gonna be the external market price that they're going to take between each subunit. So the advantage of using the market transfer price is that when there is no excess capacity, meaning, there is no more of products or capacity left to be only used to transact within the subunit. Okay, so when there is no excess capacity, this means that there's no room available for the selling subunit to sell to the internal purchasing subunit because all their capacity is going to be used to sell to the external customer. Okay, then the market price is a reasonable transfer price. Why? Because it is the opportunity cost of selling internally. So what does this mean? So when there is no excess capacity, meaning there's no room for the selling subunit to sell to the purchasing subunit, then when they're still selling it to the purchasing subunit internally, then there is an opportunity cost, right? What is the opportunity cost of selling internally? The revenue, the selling price you're giving up by selling it to the external party, right? And that selling price is exactly the external market price of $85, right? So in order for the selling subunit to not face at least no loss, right? Then the price has to cover the opportunity cost of selling internally, which is the market price, right? Of course, the selling subunit wants to sell higher than the market price, but then there is no reason for the purchasing subunit to buy at a price that is even higher than the external market price. So it's always going to be the external market price in a competitive market with no excess capacity. However, there is surely a disadvantage of the market price, which is that there's always not going to be an external market. Sometimes some products are transacted very less frequently, therefore, there's no price you can observe at a daily or even a monthly level, right? So, market-based transfer price can be limitedly used in a real setting. Okay, so we're gonna look at a case where we're gonna look at this case where market is not perfectly competitive, right? And one of the division in a firm has a excess capacity, meaning they have a room to sell their products to a purchasing subunit, right? Let's say there is a divisions S and division B. Okay, so division S implies the selling division. The division B implies the buying division, right? So let's say the division S produces the intermediate products, and division S right now has a producing capacity of 15 units of these intermediate products. And the variable cost per each unit of the intermediate product is $2, right? So in a case where the firm faces imperfect competition, it means that the firm, or in this case the division, has a power to set the price themselves. So they're not a price taker, right? As you set a higher price, for example, then you're gonna sell a lower quantity. As you sell at a lower price, then you're likely to sell a larger quantity. Okay. So imperfect competition can be reflected as the following at a downward sloping curve, which is that selling price equals 20 minus Q. Let's say this is their demand curve. Okay. And you want to make sure that the P times Q, which is selling price times Q minus the cost, which is coming from the variable cost, minus the 2 times Q, is maximized. So that is their profit function. P times Q. Q times, now we're gonna replace P with 20 minus Q minus 2Q. That gives us 18Q minus the Q squared, right? So after the going through the first derivative, you know that the Q equals 9. That is the maximizing Q, profit maximizing Q. Okay, meaning when division S sells 9 units, they can maximize their profit by $81. And when we plug in Q here, in that case, the market price is $11. Okay, so S is always going to set a market price at $11 in the imperfect competition. Now, under this scenario, division S has a surplus capacity where 15 minus 9, that equals 6 units. So they can actually have some room to sell to the purchasing division B of 6 units. Let's suppose the division B can take the intermediate product, but then they're going to incur additional variable cost of $4, and then they're going to sell it in the external market for $12. As the organization as a whole, rather than from the perspective of division B, what is going to be the incremental profit out of it? Well, that's going to be $12 that they're going to sell to the external market minus the variable cost that's incurred from each subunit, right? So $2 from the selling subunit and $4 from the buying unit. Okay, so which reaches $6 per the intermediate product. But how about division B's perspective? Are they going to purchase from S at the market price of $11? Well, no is the answer. Why? Let's look at from B's perspective. When they sell off at $12, they're gonna purchase that intermediate good from the division S at $11, which is the external market price. And further, they're gonna incur the variable cost of $4, reaching minus $3 per unit, right? So it's a loss for division B. So there is no reason for division B to take up this transaction. What does this tell us? Well, first thing is that the selling price must always be greater than the selling subunit's variable cost of $2, right? Otherwise, if it's below $2, then selling subunit has no reason to sell to the buying subunit. And from the buying subunit's perspective, they're always going to buy only when it is less than the contribution margin of $8. So where does $8 come from? The selling price minus their own variable cost per unit of $4. So 12 minus 4 reaches $8, right? It should always be less than $8 so that they don't lose any money, right? So what is the conclusion of this scenario? Well, in an imperfect competition, the transfer price is actually lower than the market price, okay? As you can see from this scenario, okay? So that is what I mean by this second point from the previous slide. All right. One of the disadvantage of the market price was that it is not it's not always available if there's no external market, right? So if the market price is not available or if it's not appropriate as you can see from the uncompetitive market scenario. Or if the market price is just too costly to obtain because there are not many frequent market in place, then you should rely on other type of transfer price, which is called a cost-based transfer price. So this is quite commonly used by many companies, and there are usually two ways, which is based on full cost, and the other is based on the variable cost. We're going to first talk about the full cost base, which is the price set at the full cost plus some margin. So margin can be 10% of the full cost or 15% of the full cost, which goes to the selling subunit. Right? So advantage of full cost is that it is easy to calculate. There's no reason we want to observe from the external market, right? As long as we can calculate the full cost of the selling subunit, then we can also set the transfer price based on the cost quite easily. But sometimes there are disadvantages. One of them is when there is some excess capacity, meaning so there are some capacity left to sell to the purchasing subunit, full cost usage may result in a poor decision. Well, this will be observed from our next slide example. So please hold on for a minute. Second, let's say if there's no margin or the margin itself is so small, then selling division may not recognize much profit out of it. So they don't have much incentive to engage in transfer prices if it's based on full cost. And then lastly, this is one of the critical reasons why full cost can be detrimental. So the selling division may have little incentive to control cost. Why? Because whatever the cost they would incur, they would always get the full cost plus margin, right? So they can always cover up the full cost, and then they can receive the margin that is the percentage margin based on the full cost. So actually, the greater the full cost, the greater the margin you can face. So there is little incentive to control cost, and even further, they may be not controlling at all their cost. They may want to even maximize their cost so that they can get a full margin out of it. One of the ways to mitigate this issue is to use the budgeted cost, the standard cost, rather than the actual cost to alleviate this problem, right? Then, even if they incurred a actual cost, they will not get a margin based on the actual, but based on the standard. So they still have an incentive to control cost. Okay, so from here, we're gonna move on to the next video.